U.S. workers say the power is once again shifting to their bosses after employees held the upper hand during the pandemic. In a new survey conducted by the Harris Poll for Bloomberg News, 58% of respondents said they believe companies have more leverage in the job market these days. Employees say they are feeling less empowered to ask for everything from raises to remote work. And the price of U.S. natural gas rose above $10 per million BTUs for the first time since 2008. That extends a rally driven by concerns that global stockpiles aren't enough to meet winter demand. In U.S., inventories are well below normal after summer heat boosted electricity demand. Meanwhile, production has grown only modestly. And that is your latest Business Flash. Guy?
Really good. Thank you very much indeed. Let's get more on what is happening with the natural gas price story in the United States, which feels very, very minimal compared to what we're seeing over here. But nevertheless, I guess all these changes are going to have an impact. Joining us now, Mike McGlone, commodity strategist for Bloomberg. Mike, what do you make of what is happening here? Is this the ripple effect of what is happening in Asia and in particular Europe now feeding back into the United States?
Well, all the above. I think you described it very well, Guy. Compared to Europe, it's minimal. And it's the ripple effect what's happening in Europe and Asia, in particular with the issue in Europe. But the thing about U.S. gas is that price of 10, I really think of the producers. This is well above their cost of production. And you look at the forward curve around 10, but a year from now it's closer to 6. I believe that forward curve partly because we're hitting those two key shoulder months, September and October, and I fully expect that supply to come on. And then you got to price for a really bad winter for keep these prices high because we just can't export enough through LNG. So prices at these levels means your average producer, even if they sell a year out, is still making about 3 to 4 times their costs. So thank you very much. Think of the producers. What they're going to do is bring on that supply. It's just really rough, more rough for Europe.
Well, you're saying think of the producers. I think about the consumers as well, Mike, and at what level we're really talking about serious demand destruction.
Yes, well, that's true, and it's going to get that clearly in Europe. It's almost guaranteed to be a recession when you have 5 to 10x times your electricity and energy bills. In the U.S., a lot of people are going to get 2x times their bills, and what you have to do now is plan for it and cut off for it now. So it's almost a guarantee we're going to tip over to that recession. It's also showing up in one of those key indicators you can see realistically, and that's U.S. implied unleaded gas demand is actually declining at a more rapid pace than 2008, and that's just you can see it more fluidly. So I look at it as demand destruction is part of it, and it's supply and demand elasticity. Never underestimate commodities, particularly you want to have really good profits and when you spike this high. So I love to be bullish commodities, but at these levels, man, you got to be very careful.
Mike, let's talk about what's happening in the ag space. It does overlap into the energy space, but nevertheless, it has been dry. The world is looking to the United States for food. How bad are the crops going to be? The initial survey suggests quite bad.
Yes, well, that's actually not a surprise, Guy, because the initial survey started out west. There's a pretty severe drought out west. Where I'm from, in the Heartland, the Corn Belt, that area is still basically a green belt effect. So fully expect the corn yield to stay about 175 bushels per acre, and probably the best soybean crop ever. So remember, corn's really made in July, and soybeans are August, and August is almost over. So now it's really about, okay, you watch over Russia, Ukraine, but that crop tour, as it gets towards the Corn Belt, you're going to see that data in a few days. We probably should confirm 175 bushels per per acre in corn.
All right, Mike McGlone of Bloomberg Intelligence, thank you as always. Coming up, we're going to turn to retail. Macy's gaining 7% despite a forecast cut. We'll discuss why next. This is Bloomberg.
Amanda Gordon.
We are an hour into the U.S. trading session, and the good news is Tuesday is looking better than Monday did. Bloomberg's Abigail Doolittle is tracking the moves. Abigail, we're on the up, though we're not quite to a level in which we'd recover the losses of the last 2 days.
True, although what a difference a day does make, because we're not looking at deep declines. Instead, we have that S&P 500 up about 0.2%, the NASDAQ up about 0.4%. Into the open today, we had stocks fluctuating, small moves, mixed moves. But at this point, because of the PMI numbers coming in so much weaker, it suggests to some folks that maybe the Fed's not going to have to raise. In fact, take a look at that 10-year yield, now flat to down. Oil higher. This is Saudi is saying that OPEC Plus may have to, in fact, cut production. So we have oil back above $93 per barrel. In fact, let's take a look at what's been going on with oil, because we've been seeing a nice little bump up. And this could, in fact, not have to do just with supply uncertainty, but maybe some idea that demand's not going to be as bad as feared. So you can see over the last 5 days, oil gaining nearly 8%. Not so bad, especially given the last 2 days into today of stock declines, because both oil and stocks, risk assets, often trade in the same direction, but not so much right now. As for the PMI, let's take a look at what's happening, not just here in the U.S., but globally. It's been a bit of a brutal streak here, really pointing to the idea of recession, the feared recession that so many folks are talking about. In the U.S., the composite PMI coming in at 45. The prior had been 47.7. The contraction piece of this was on the services side, coming in around 44, a complete miss of the survey, down on a month-over-month basis. Now, the PMIs for the S&P, those are smaller to mid-sized businesses. The ISM, larger companies, holding up. But nonetheless, this is something to keep an eye on, especially since many have been saying that services would hold up after coming out of the pandemic. It would be manufacturing that could have a problem. That's not the case. And you can see that Germany, Japan, the Eurozone, France, Australia, all in contraction territory. Finally, Guy, where we saw a very quick reaction to that big miss for the U.S. PMI, especially again on that services side. Take a look at the dollar. You have it down 0.5% on the day. Right when that number came out, you know, this points to strong U.S. weakness. A nosedive down, trying to come up a little bit, but this is not pressuring stocks. That could be why we have the S&P 500 and the NASDAQ up slightly, at least right now.
Yeah, and they sold off pretty hard yesterday. Abigail, great stuff. Thank you very much. Abigail Doolittle on what's happening with the markets. One stock that is having a great day is Macy's. It's gapped higher first thing. The market seems to be rewarding it for being prudent. So the stock's up 8%. This despite the fact that it's cut its full year forecast, the department store owner blaming basically tighter consumer budgets and a glut of inventory, which is now leading to markdowns. But the market thinks that what it's saying is prudent, as a result of which the stock is sharply higher. Joining us now is Bloomberg Markets, the close co-anchor Caroline Heiss. She just spoke with Macy's chairman and CEO, Jeff Gennette, on those results. What did he have to say, Caroline?
Well, actually, sounding pretty buoyant, probably unsurprising given the market reaction. I think the market and analysts had braced themselves. They know that the consumer is weakening, and he spoke to that. He said, look, the consumer is under pressure at the moment. Gas prices higher, food prices higher, saving levels coming down. However, there's a great quote that I want to bring to you, because he did say, actually, the consumer is quite healthy. And I thought this was really notable, that he's really talking about an ability that this is an area of actually still spending in particular. I really want to draw attention not only to this quote saying that I think the consumer is actually healthy, but they're under pressure. He does talk about the wage rates, but he also talks about the luxury end, Guy. And here is where the strength showed. Bloomingdale's, Bluemercury, the $250,000 a year earner, the family is still strong. They are still spending. They're still wanting to be getting their luxury items from Macy's and the overall areas and brands that they own. So he was saying, look, this could be a short cycle. At the moment, he's not wanting to say he sees a recession.
All right, well, while we're looking forward, and I know it's not even Labor Day yet, so we have to keep that in mind, but the holiday season, how optimistic is he feeling about it?
He is feeling optimistic about the holiday season. He wants to be able to pivot. The minute that the consumer is there with demand and wants to buy, he says they're set up in the right direction for the holiday season. They did well in terms of Mother's Day, Father's Day. It was just after Father's Day that the consumer started to pull back slightly. That's when the inventory levels started to rise up. Even though I have to say it's only up about 7%, it's much better than some of the rivals. And indeed, he says the pressure for cutting the overall prices of certain, say, pandemic spending that we had, say the athletic cosmetic gear, the home items. That's because the industry has too much inventory, not particularly his company. And he says overall he's pretty proud of the inventory levels. But for the holidays, he says they've got the right content, they've got new merchandise, and they think they're going to do well from it, Kaylee.
All right, Caroline Hyde, co-anchor of Bloomberg Markets The Close. Thank you so much, and looking forward to your coverage later on this afternoon. We want to get more on retail on this show now, though, and welcome Mark Cohen, Columbia Business School Director of Retail Studies. He was also the former Sears Canada and Lazarus CEO. So, Mark, great to speak with you. As we look at Macy's results, and Caroline painting a picture there of the CEO that still sounds very optimistic on the consumer and its propensity to spend, what do you see when you're studying the retail sector in this kind of economy?
Well, I'm sorry to rain on Macy's parade, but as the innkeeper in Les Mis says about her husband in a kind of a bawdy line, there's not much there. Macy's performance going into COVID wasn't very good. It certainly didn't distinguish itself during the height of COVID, and all that I can say is beating the analysts' estimates is good news, but it really doesn't say much about the future. The economy is shifting from dead stop to hyperactive in particular categories driven by the pandemic. It's shifting back into some semblance of normalcy. The luxury customer is absolutely out there shopping, so no surprise that Bloomingdale's business is very good. But as we all know, inflation is a cloud over the consumer for most consumers. Unemployment, which has been great, is starting to show signs of a bit of a downturn as layoffs are being announced virtually every day. And so the outlook that Macy's offered up is probably completely correct. It matches the outlook of other retailers. The question is just how will they be able to pivot through this holiday season?
I get from your tone, Mark, that you're not convinced that they will be able to pivot. Is this the wrong business for this economy?
Well, you have to ask yourself, what does Macy's stand for? And in point of fact, I think they have been struggling for many years in trying to differentiate themselves. They are one of the last quote-unquote men standing in the department store channel. But having said that, the customers clearly gravitated up into luxury, true luxury, and down into the Walmart, Targets, Amazons, Costco's of the world, leaving Macy's kind of in that middle ground that really doesn't offer them any kind of differentiation that they can count on.
Okay, so is it going to be more difficult for Macy's to right-size some of those inventory issues that we've also heard the more discount retailers, Target and Walmart, talking about?
Well, it's not so much difficulty as cost. You know, you own too much relative to your rate of sale. You take markdowns, which eventually remedy the problem. We've seen Target and to a lesser extent Walmart step right up to the plate and fix their inventory balances to get them set for the back half of the year. Macy's says they're in pretty good shape. I'm sure that they're accurate in assessing that. But the real issue is, where's the customer going to be and what do they have to sell that the customer is going to seek them out for? And they have really not been able to find points of differentiation that allow them to stand out other than relying on their off-price strategy called Backstage, which I think is a mistake in the mid to longer term.
Yep. Mark, do you think we're going into a recession? And if we are going to a recession, which retailers are going to do well?
Well, you know, recession is a term that really has no meaning outside of Wall Street. What is the man and woman on Main Street think of when they think of the economy and its outlook? Well, they think about their wages, their disposable income. They think about prices. They think about interest rates as it influences their mortgage, their car loans, their consumer card debt. And so I think we're teeter-tottering at an inflection point. Whether we tip into a classical economist definition of recession, I really don't know. I'm not sure that it really matters. I think that there are signs that inflation is moderating, at least at the gas pump. I don't know that outside of gas and grocery prices are really going to decline, but they probably will stop rising at the rate they have been. So I think we're looking at a tough fourth quarter. I think that the Targets, Walmarts, Costco's, Amazons will continue to do extremely well. I think that the Macy's of the world are going to struggle.
And Mark, finally, you were mentioning wages there in the context of the consumer, but I also wonder about wages in the context of the retailers and what they have to pay employees. What is your read on the pressures on the labor side for these companies?
There was tremendous pressure during COVID to bring people back to work, to bring people on board. And so retail is a big piece of the labor market, as you know. And so wage rates rose, benefits rose, all sorts of pops and perks were introduced by progressive retailers to attract and hold their workforce. It's an inflationary pressure when you get right down to it. It makes your cost of doing business much more challenging. So it's out there. I think that at the end of the day, retail is all about having great product in a setting that customers enjoy shopping, whether it's online or in store.
Yep.
And that requires a workforce that's committed to representing you.
Mark, great to catch up. Really useful insight. Thank you very much indeed for your time. Mark Cohen, Columbia Business School Director of Retail Studies. Thank you very much. Coming up, Gold Fields investors may be softening their opposition to the company's planned acquisition of Yamana Gold. We're going to speak to Peter Marrone, Yamana Gold Executive Chairman. That conversation is coming up. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. Gasoline prices in the U.S. have now fallen for 70 straight days. That is the most in more than 7.5 years, according to the Auto Club AAA. Pump prices are averaging $3.89 a gallon after reaching a record high of $5 in mid-June. Apple plans to begin making the iPhone 14 in India about 2 months after the product's initial release out of China. That narrows the gap between the two countries, but it doesn't close it completely as some had anticipated. Apple has been trying to diversify its supply chain, but the company's high standards for secrecy complicated its efforts in India. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Kaylee.
Ritika, thank you. Goldfields investors may be softening their opposition to the company's planned acquisition of Yamana Gold. That's according to Goldfields CEO Chris Griffith. Meanwhile, earlier this month, Barrick Gold CEO Mark Bristow told us that he's not that convinced on making deals within the industry.
These times bring opportunities, of course, but right now we have embedded in our portfolio quite a few growth opportunities without having to go out there and make acquisitions. We've looked at a lot of the acquisitions, and it's that discipline that gets you through the long term, is not to get caught up buying premium assets at a premium at the top of the market, which we saw at the back end of last year and early this year.
All right, he may not be that into acquisitions right now, but clearly other companies are getting in on M&A. Peter Marrone, Yamana Gold Executive Chairman, is here with me in the New York studio to talk about the deal. Let's talk about the deal's approval. How confident are you that shareholders are going to give this one the thumbs up?
Well, I think the word that was used initially was opposition. I wouldn't consider it, Kaylee, to be opposition as much as information. Shareholders are in need of information. We spent 7 months, the two companies, conducting diligence on each other, so it's understandable that a deal that does not initially look apparent, it's understandable that they would want to know why we did the deal, why there is a premium being paid for the deal, why Yamana is getting a premium on the deal. And as we've been explaining that, we've begun to see that there is significant growing support for the deal.
Why is M&A the right move at this moment, Peter?
Well, I think the best way for me to answer that is to look at the broader market and in the context and compare it to the gold market. Here we are with an industry that is comparatively small and very fragmented. And even with the corrections that we're seeing in the market, we see the companies are multiples of the size of the entire precious metals industry. If we look at the market capitalization of the entire industry, we're probably looking at $250-300 billion, and that's a fraction of the size of one of the big technology companies. During that same period of time, we've seen resource funds that in many respects have been decimated, and we've seen bigger funds, assets under management, that have grown. And so I think there's an element of relevance that has to come into this picture. The larger the company, the more likely it is. Quality always counts, but the larger the company, the more likely it is that it will attract the attention of the broader market.
So you expect more M&A activity in gold in this space then?
I'd be very surprised if we didn't see it. Certainly, we've seen it among some of the larger players. We saw a larger merger than ours late last year, closing this year. Interesting that you mentioned Barrick, but Barrick was the result of a business combination a few years ago. So I think it's kind of cute to say that we're not going to see it. It's cute to say that we're not going to do it. And equally cute to say that there is a discipline that comes from maintaining the course. There's discipline that comes from maintaining the course, but also when a business combination makes sense, then you should pursue it.
But what you're saying is that this is about attracting a new investor to the businesses that are aggregating. Are there operational effects of what you're doing as well? And Peter, do those also make the deal look attractive?
Let me answer that in two parts. I would say that in many respects, what we saw as a simpatico between the two companies is that our assets punch above the weight class of the size and scale of company that we are. We saw something very similar with Goldfields. The result of which then is if we bring the two companies together, we actually create a critical mass of high quality assets, a high quality portfolio that continues to punch above its weight class, but is, if we look at the company, it becomes amongst the 3 largest companies in the precious metals space, but yet it has longer mine life, it has better free cash flow and free cash flow conversion from cash flows and revenues. It has better growth and has better costs. And so it seems to me that the quality and the size and scale improve as a result of the transaction. Is there an element of a market force that comes into this? I think the answer is yes. But it has to be the right deal at the right time, and we believe that this is the right deal at the right time.
Okay, so that's the deal. Let's just talk about your business as well, which in large part is going to be dependent on the price of gold. What is your assumption about the trajectory of prices, given Guy and I spend every single day on this show talking about central bankers around the world tightening policy?
Well, someone said some time ago that it's very difficult to predict gold price. Indeed, the way that it was positioned to me was, don't try to predict gold price because only fools and liars try to predict gold price. Very difficult to look at where gold price will be within a finite period of time.
But even if not a hard target, would you guess the trajectory is going to be more up or down in the near term?
Well, I would say that gold is doing exactly what it's supposed to be doing. In the context of a very volatile market, there has been a downward pressure on gold price, but nowhere near the level that we see in the broader market and in other sectors. And so we've seen a reduction to gold price, but it has been far more balanced than many other industries and many other sectors. Where do I see the trajectory going forward? I think the answer is up and way up to where it is today. May I comment that gold price has not reached its height. We talk about $2,000 per ounce just a year and a half ago, but gold price reached $840 per ounce in 1980, and we were in the middle of a similar period of high volatility, geopolitical risk, and we were in a period of significant inflation. And we saw that $880 gold price, and if we look at present dollar value of that, it's closer to $2,700, $2,800. And I think there's certainly upward room to get to those numbers. Whether or not that happens within a year, within a couple of years, within a couple of months, that's difficult to say, but I think that the trajectory is up.
Peter, has inflation peaked in your world?
Inflation on consumables is still there. We're seeing some adjustment to that. Clearly, oil price, the impact of that on diesel is downward. The best way for me to answer that question, though, is to say that we're not really that heavily dependent on consumables. If we look at our fuel costs, it's about 5-6% of our costs. Energy represents something similar. Where we're more heavily dependent is on labor and labor equivalent. So in other words, contractors, and treating that as the equivalent of labor. We're about 40-45% of our costs are represented on labor and its equivalency. And so there, we are more sensitive to movements of local currency. So if we accept that the dollar continues to stay strong for longer, then local currencies are likely to adjust, to stay weak and likely adjust lower. And that is a positive to our costs.
All right, Peter, we have to leave it there, but thank you so much for joining us and coming into our New York studio. Peter Marrone, Yamana Gold Executive Chairman. This is Bloomberg.
35 minutes to the European close, and European equities continue their journey lower. The Stoxx 600 now trading 431. We're down by around 0.5%. Healthcare in particular adding some weight to the bottom end of the market. Yesterday rallying, today certainly fading. We are getting some euro strength, though actually I think realistically this is dollar weakness generated by that incredibly weak services PMI number that we got a little while ago in the last hour, catching everybody by surprise, and that has been the effect. You've also seen a move in front-end yield stateside that looks fairly dramatic as well. We are still, though, significantly below 1, so we are below parity. And then you've got this Nat gas story, which is just giving back a little bit today, but after the steep rallies we've seen over the last few days, it is unlikely to continue at that kind of a rate, so we are getting a little bit of a fade, but it's so volatile what is happening here. But overall, the longer-term chart, absolutely parabolic. Coming up on the European close, we're going to carry on talking about what's happening with these markets. Europe, the PMI data on our side of the pond not looking good. Dean Turner, UBS Wealth Management economist, going to be joining us to talk about that data from the UK and the Eurozone next. This is Bloomberg. Tuesday, the 23rd of August, European equities fade, energy's up, healthcare is down. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close.